Welcome to Money Matters with Greg, where we dive into the money conversations shaping your life. From investments to estate planning, insurance to taxes, we cover it all with a fresh perspective. Join Greg and his guests each week to get inspired and take control of your financial future. Let's get started. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.
Here we go. Money Matters with Greg. Here we go. Cannot believe we're back again. It's taken too long, but welcome back to everyone involved. To be here is a privilege and an honor. Very excited to have the opportunity to produce the show again. It's been a long time coming. We had 147 episodes on Money Matters with Greg on Apple and Spotify and a number of places, either through our podcast, and then also episodes with our local radio station, WVLP 103.1. And we basically push pause on that after COVID, and then really just being able to have to produce everything on our own was a trying task. But we did a number of episodes that feel like were beneficial and helpful for everyone in the financial world, and certainly with money and what how money matters in your life. But we're back. 2025 is now a new focus and with new ideas, and we're really excited to bring some great things to you, to the audience. We are back at WVLP 103.1. We will be on Thursdays at 1 o'clock and then replayed on Saturdays locally. And then we'll be broadcasting here, podcasting, and also making sure that we are up and on YouTube and our YouTube channel. So really excited to be back. It's been too long. I've missed you. Missed everyone and visiting with everyone. What we try to do on this podcast is talk about how money matters and the money matters in your life as far as your finances, but also psychology, everywhere that intertwines and weaves through your life. Somehow financial matters and money matters really do affect everyone in multiple different ways and facets. So we'd like to bring on a number of guests. We plan to have a number of guests as we broadcast every week. And we'll just see how this goes. So really excited. We had a ton of followers before, and certainly hope to ramp that back up and get back after it. With that being said, that's enough of the house cleaning for now. Really looking forward to being a part of this and ready to rock and roll. Wanted to talk about the first episode here. I've made excuses on, not doing this and not doing that. I've said to myself, you know what, you're fat and ugly. You shouldn't be on video. To, really should just keep this as a podcast and not be on TV or on the radio. I do have a face for radio, and I realize that, but certainly gone back and forth. We're trying to use all the different mediums we can. We'll do YouTube and try to help people out, whether we're actually producing through camera or on camera or not. We're just really looking forward to the different mediums we're able to use. Obviously, social media as well. We're allowed Facebook, LinkedIn, X, and now Instagram. So we're allowed to be on that as well as Facebook. So find us in those venues and those socials as much as you can. I wanted to talk about the first episode was 2024. What a great year it was. Obviously, 2023 in the markets. We've had another number of years. I am CEO and president of CEO and owner of Farrall Wealth. It's a wealth management firm that is local to Valparaiso, Indiana, where Valparaiso University is located. We are in a great town of about 35 to 40,000 people in the small Midwestern town of what kind of feels like Norman Rockwell. And Orville Redenbacher is our institution here with our Popcorn Fest and a number of other things that are a small town nostalgia here in Indiana, just outside Chicago. But we do service clients in 21 states nationwide. We work with a lot of high net worth, ultra high net worth individuals and families and their businesses. We work on plan sponsorships as far as retirement plans, a number of things, investments, debt, you name it. We talk about it all, estate planning. And that's really what we started this podcast to do, is to bring some of those conversations to you as an audience and give you some knowledge throughout the years and throughout the episodes to be able to sort of, take with you some of the conversations we're privy to. I've always felt like many of the conversations I'm lucky enough to have with clients, friends, family, and whatnot are conversations that everyone should hear. And that's really why we started this, was to say, okay, how can we bring more ideas to everyone? And this is how we're going to do it. All right. With that being said, 2024 was a fantastic year. I want to talk about what we did right and what we did wrong in 2024. I think a lot of people, the prognosticators out there, they never seem to go back to where they started out at the beginning of the year and talk about, how many mistakes they made, or how many things that they got right. With the last 2 years of investment returns, at least with the S&P 500 and a number of other indices, we've had some really, really good runs. Obviously, the S&P 500 last year was up nearly 25%. Nobody saw that coming. And that's really what I want to be able to say is, for the last 2 years, there's some really big brains on the street. There's some great people at Goldman Sachs, JP Morgan, T. Rowe Price, Eaton Vance, you name all the names you want to be able to name that are out there. And every single big brain, every single person out there, including ourselves, with what we do and how we manage money, we were wrong. I think the highest prognosticator last year for the market was 8.5%, and the range was between -10, all the way up to like 8.5%. And they're not just wrong. I mean, everyone was just dead wrong. We're up almost 25%. It's been a crazy year. A lot of that has to do with Magnificent Seven and the seven stocks that drove S&P returns. If you look at the difference between equal weighted S&P 500 and just regular S&P 500, the returns were incredibly different, and equal weighted underperformed just the S&P straight up. But that being said, I'd like to be able to go back and say, all right, well, what did we personally get right? What did we get wrong? I want to be able to share a screen with you real quick and basically bring up some things here. If you're on YouTube and you want to be able to see this, you certainly be able to run through. But what we got right and wrong in our equities was really staying fully invested. Really, really key to, let's just start with the most important call was stay invested in a volatile time, even in an election year. There were some times personally where we did circle the wagons a little bit, as we had just a phenomenal beginning of the year, first 6 months. Got a little nervous right into July with the earnings numbers, raised a little bit of cash, went into some treasuries. But not a lot. I stayed fully invested in the growth markets as well. But the Magnificent Seven names of Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla really just sort of mask the relatively broad participation of the S&P rally last year. But you know what? The biggest drawdown of the year was 8.5%. And, that would have been an opportune time, obviously, to get in. We were buyers at that time. That's feeling pretty good about that. But, really that sort of September was kind of, it was definitely a hiccup we didn't see coming. Going into November, really thought basically who's going to win was going to affect the market. So we were certainly nervous about that. You saw volatility in the VIX index rise up during that time. But staying fully invested was and typically is the best way to be able to drive your returns. If you saw mega caps, they didn't really have a ton of heavy lifting, but you see the Magnificent Seven returns, and then you also see the equal weighted and the regular S&P 500, and you see the difference in those overall. Basically, like I said, equal weighted underperformed. Growth over value was key, so that was very, very important. Stick more growth versus value. You saw the growth stocks do really, really well in 2024. Overweight communication services, favoring U.S. over emerging markets was another solid call. Communication services was the top performer of almost 40%. And real estate gained just 5% for the year. So overweight communications, underweight real estate. It's really, really solid. With EM and emerging markets, it was all about China for sure, underperforming. The overall EM index returned only about 8% last year. So, inferior economic and earnings growth, and again, a strong dollar. Now the strong dollar after the election of November 8th has mattered very, very much and mattered in 2024 immensely. So the dollar has gotten much stronger. Tariff implications as well, what that all looks like. On November 8th, that morning, I was up until probably 4:30. It was like my Super Bowl. Watching markets, seeing where things were changing, and it was literally just a flip overnight. You went from, anti-tariff conversations or to tariff implications and how they're going to affect the overall markets. You saw industries like U.S. steel and the U.S. steel industry go up 17%, 20% in some stocks. You saw anything to do with China go down 20%, 17%. Anybody that having major work in China and then importing into the United States was affected. And South Korea was particularly a huge drag against the performance for the year overall, even though now we're sort of seeing this trend of, well, definitely seeing this trend of people leaving China, businesses leaving China, businesses trying to find a way out of China and move towards Vietnam, South Korea, Japan, Mexico, and a number of other countries. We'll see how that sort of falls in here into 2025. But U.S. equities again outperformed international and emerging markets from the start of 2024 all the way to the finish. You see here all the way from Jan to December overall, and then the blue line, the Russell 100,000 index, outperformed all the way across the board. What we got wrong was, as I said before, the S&P 500, the target was just too low. I mean, everybody was wrong. Again, I mean, this is 2 years in a row where nobody can really herald, hey, I nailed it. Not even close. Our LPL research raised the S&P to 5,500, and it just galloped right past it. Do anticipate the price to earnings ratio multiples expansion, sort of given the higher interest rates mattered, but as it turned out, the macro, economic and profits, overall outlook was just strong enough to support a PE that we thought would be more fairly priced at 18 or 19, and it was closer to 22, and the forward earnings estimates. But hey, it was a great year. The other thing too was energy recommendations was a miss overall. Watching to see, we were trepidatious about this. This is LPL's research call. We didn't go all in on this for sure, but there was an overweight recommendation from our research department on the energy sector. Was definitely worried about that in regards to where the current administration was And in the future, we'll see. I mean, even though oil spiked just recently in the last week here in January, and the date of this broadcast is actually January 12th on a Sunday. So we've had a rocky start to January to 2025, but I'll talk about it in a second. So what we got right and wrong in fixed income really was a disappointing year in fixed income again. Even though the Fed came out and really sort of gave us stability across the board in regards to their cutting interest rates and also their forward guidance on cutting interest rates. Typically, you see forward cutting interest rates, you see bonds actually perform well. It was pretty boring. I mean, the S&P, the overall Bloomberg index was only up, 2% ish. And a lot of the credit, U.S. credit, just didn't perform very, very well. The only place you really did see was high yield. We actually, as a firm, were overweight high yield. LPL did not invest in high yield bonds, and they basically say that they had a miss, and you'll see this on this presentation today that I'm flipping through here on YouTube. But and by the way, you can find the same broadcast on our YouTube channel at Farrall Wealth on YouTube. But going into 2025, really the views of corporate credit would kind of remain the same. With interest rates going down and looking like the Fed is going to cut twice instead of four times, which they sort of preempted on December 23rd of 2024. You're really just sort of seeing how economic conditions are currently and how they will be. We'll see where that looks here in the future. Right now, we're cautious and just sort of following what the Fed is leading us to believe overall as far as their cuts and when they might cut, and following Chairman Powell. Look, a lot's going to change here in 2025, with the inauguration. So we'll see what happens about that. Corporate credit markets, they're resilient, but they are expensive. With that being said, getting that yield is not easy to come about. And so be careful in regards to that as far as corporate in the future. We're definitely watching. We want to get quality companies with quality credit and also quality coupons. So that's tougher to come by than it was just 6 months ago. There were a number of different companies out there that were offering some really great yields out there, but now they don't necessarily have to as much. So concluding on all that for 2024, I just want to kind of wrap 2024 up. Hell of a year. Congratulations to all that stayed involved as far as stayed invested. There was a number of different things that worked well, and we're certainly seeing those trends continue here in 2025. With that being said, really, we just want to talk about the key to the stock market gains in 2025 and what those look like. Really trying to make it simple. I'm just basically going to talk about four main things, but the Nasdaq was up over 31%. I didn't mention that. The S&P, 24 last year. It was still with some of the indices that even lag those. I mean, the Russell 2000 of 12, 13%. Dow Industrials overall, which really nobody follows anymore. And if you follow it, it's because you're my great-great-grandfather. But as we turn this attention to really support the past year, I really want to talk about some of the pillars that are going to matter here in 2025. So as we look ahead to 2025, I really have to talk about where the market is priced right now. Is it expensive based on earnings and based on PE? Yes, it is at the highest number and has been at the highest number, but that doesn't mean it's the most expensive. I traded through the dot-com boom and dot-com bust as an individual trader at the Chicago Board of Options Exchange. So I was there with my team and my clerks and the company that I owned with two other partners. And we were constantly looking at thousands of different option contracts in thousands of different names or hundreds of different names as far as those stocks and those individual stocks. And at the time, there were no earnings. There was just price. So, we got up into the 24s and close to almost 25 PE ratios where earnings weren't real. And they're basically just stocks just went up. And that's ultimately what happened when the world fell apart and everything rocked back in 2003. But right now, even though things are a little bit more expensive than where they've been, and we've had a great year, a great 2 years, we really kind of walk through the earnings and the earnings numbers, and you've really got to concentrate on earnings to see if it's warranted where we are at 22 times right now. We are not at the most expensive place we've been. We are more expensive than we have been. As of Friday, we were down over 500 points. So that certainly rocked us back a little as far as valuations. But most importantly, we want to talk about four main pillars. And the first one is that there's no recession. You have had the talking heads for the last 2 years talk about recession, talk about we're going into recession, talk about whether it be a soft landing, talk about whether it be a hard landing. It has been nauseating at the very least for these conversations as far as what happens. And right now, you don't hear anything about it, which is amazing. But it's very, very important that when no one's talking about it, that you are paying attention to what is really, really important, which is, look, the bull market has entered its third year, and we've advanced over 67% since it began in October 12th, 2022. And it has a good chance of celebrating a third anniversary going into a year after an election. The S&P for bull markets a good through year three, the S&P has gained an average of 5.2%. I know that sounds anemic compared to 25, but that's the reality we're in. I mean, let's check our name at the door and make sure that we're putting our expectations in hand. You're looking at two cuts on the federal, from the interest rate side from the Fed, and economic growth is going to be slow. I mean, it's resurgent inflation has definitely picked up, and we'll see how this all goes. But history says that the S&P will be up on an average of 5.2%. We're looking for between 7 and 8% for the year. And again, checking our expectations at the door and making sure that we're having these conversations with clients and you for sure to say, hey, look, you need to be invested. It's just a matter of where, and also know that, 25% is just not going to happen every year for sure. I'm showing now the bear market bottom and the bull market peak of year one, year two, year three for the last number of years. This is a year by year analysis of the bull market performance. You can see this. You can see it obviously on YouTube when you get to a chance. It's a great fact set that LPL research came out. And just overall, as far as the data goes as to where they are. But you know what? October 12th, 2022, year one, we were up 21.4, year two, 32.2, S&P overall, and then where we go from here, who knows? So we'll see. The second is the supportive Federal Reserve. They have been very supportive in regards to a number of things as far as their information. Although I think Chairman Powell personally hates the stock market going up and loves to do everything he could possibly do or say to turn that around. Hence, just comments back in December that basically killed the Santa Claus rally. So, but that's just my personal opinion, and I wish at times he would just stay quiet. But that's just, I guess that's his MO. With talking about the overall equities market. I wish he'd just stick to his job with the Fed. But stocks usually do rise after a Fed cut, after a Fed rate cut begins. You see 6 months later and 12 months later here as far as performance goes. You see typically they're up. So history again says, where are we here in the future? Two things. You need to talk about recession and the fact that there is no recession. You need to talk about supportive Federal Reserve. That's also a positive. Corporate America must continue to deliver strong earnings growth. This is, without a doubt, probably should be number one. It is very, very important that we follow earnings, and with earnings, we follow the market. So the forecast of earnings per share in 2025 is $260. It's in line with the long-term average earnings growth rate of nearly 10%, but that's below the consensus nearly up estimate of about 15%. So that's our forecast where we have. So it's a little bit less aggressive. For 2026, we're estimating 275 in the S&P. Earnings per share, and that's about 6% above 2025. So forecasting earnings that's below consensus is almost always a winning move, but with tariff risk in 2025, without any expectation, really the benefits of any tax cuts until 2026, or at least the Trump cuts staying in existence, it sort of just basically makes us a little nervous, just because we don't necessarily know what's going to happen. And I tell you, I mentioned this earlier, we don't know what's going to happen at all after January 20th. I mean, there's just a ton of stuff coming that might be affecting the market overall that we're going to have to digest and just sort of see where we go from here. So that's basically our current estimate, LPL Research's estimate. And we concur in the consensus of the S&P 500 earnings per share estimate overall. And then lastly, the fiscal, regulatory, and trade policy really offers more upside risk than downside risk overall. So Trump 2.0 is expected to really reduce regulations, cut taxes, while also increasing tariffs. And all of these are the policy objectives that were mentioned on the campaign trail, including slowing illegal immigration, reducing trade barriers, returning illegal immigrants as well, to see where that happens, what happens with that. And the potential upside for a business-friendly regulatory backdrop is in place. We believe that that's really a positive sign. And the tariffs risk are really, they're clear. You know exactly what you're going to get. For the most part, he said across the board, if you produce products inside of America in the U.S., you will not have tariffs. If you produce them outside and bring them in, there will be tariffs. So it's pretty black and white, pretty cut and clear. Protectionist trade policies have put it, the great into a Great Depression. This higher import cost really hurt profit margins for importers as a retaliation that can impair growth. But in that situation, that was not a clear mandate. It said, look, fine, go ahead and make everything inside the United States, and you won't have to deal with that. So we'll see how that goes as far as the market enthusiasm on tax cuts, as well as the trade policy. Bottom line, that's really solid for another 2025. And the policy from the Trump administration will deliver probably more benefits than cost, at least as well as the market is concerned, which is really what we care about. So our 4 strong stock market, economic growth, no recession, combination of the Fed, strong profits in corporate America, and fiscal and regulatory policy from the Trump administration is really helps more than it hurts. So we're going to talk about that throughout the year. Really wanted to be able to just talk about some of the things we're looking at, or at least the top 4 things as we go in here overall into the future as investors, and as we try to find those trends that that we know and intend to follow as much as possible here in the future. So with that said, I hope this is a help. I'm looking forward to 2025. I hope you are as well, and really excited to be back and back in the saddle here as it might. Again, broadcasting on WVLP FM 103.1 here locally in Valparaiso, Indiana, and also podcasting on Money Matters with Greg weekly as we move on here. Any suggestions on topics you might like to hear about? Would love to hear from you on our socials at Farrall Wealth. It's FARRALL WEILTH. You can find us on all the socials and anywhere you pod. So hope you have a wonderful week next week. Happy 2024. Happy National Championship to the Fighting Irish and also the Ohio State Buckeyes, as we look forward to talking a little bit of sports as well. Congratulations on making the national championship in the football world. It's been quite a year for sure. As I follow my Indiana University Hoosiers, who had a fantastic year to dream about for sure. And looking forward to a 2025 that is profitable and healthy for everyone involved. Thanks for watching. Thanks for listening. And we'll be back at it again soon. See ya.
Thanks for tuning in to Money Matters with Greg. We hope you gained some valuable insights today. Remember, your financial journey is personal, but you don't have to go it alone. If you enjoyed the show, be sure to subscribe and share. Until next time, here's to making your money work for you. Securities and investment advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.